Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and let's move on to our next segment where we'll be talking about having an exit strategy from a mutual fund. A lot of time, people say that you should be invested for a very long term mutual fund, but then what does long term actually mean? And just as how you plan an entry in a mutual fund, which is actually not required, but a lot of people do that, do you also need to plan your exit in a mutual fund? Even if it's a long term investment instrument, how do you actually, how does a mutual fund actually qualify that particular place in your portfolio for a longer period of time? What are the parameters that you might want to consider before taking that call of exiting a mutual fund? Let's discuss all of this. I am joined by Shilpa Bhaskar Gole, founder, NerdyBird Financial Wellness. Shilpa, good evening and welcome to the show. Just a quick question before I ask you the crucial ones about the parameters of how to exit a fund. Do your clients or do you come across a question where people ask you whether how should you exit a fund, or does that even exist as a concept when you talk about investing in a mutual fund?
Thank you for having me on your show, Kavita. And that's a very important question. And a lot of my clients do ask me this question around exiting mutual funds. So I think the first assumption that's important to have is that you are talking about people here who are reviewing their portfolio on a regular basis. And they're reviewing it from the perspective of goal-based asset allocation. So we're saying that whatever mutual funds you have in your portfolio are there to help you accomplish your goals. So with that assumption in mind, yes, a lot of clients come to me with that question. And what we look for is what are these exit cues? So when you're reviewing your portfolio, what are some of those reasons which could lead you to having an exit strategy? That's very important to be seen, Kavita. And I find in my area of work that there are 4, 5 typical reasons why people will want to exit from the mutual fund. So one question that I get asked most often is, Shilpa, I am invested for a long term goal. Like you were also mentioning, mutual fund is a long term strategy. So when is a good time for me to get out of this mutual fund and redeem my amount? That's number one. The second important exit cue and exit strategy that people would want to have around is when they are over diversified. Very often I find that people come to me with 15 and 20 mutual funds in their portfolio. And then the question is, now what do I remove from this portfolio and how do I exit some of these poor performing funds, so to speak? That's number two. The third point that I notice very often is in terms of asset allocation. Very often I find that there are people who are very aggressively investing in equity, which is great for a long-term goal. But what happens because of that often is that there is a lot of concentration towards equity in their portfolio. So even from a rebalancing point of view, an exit strategy is very important for clients, Kavita. So these are the top 3 reasons that I find very often. Some of the less proactive reasons, I would say, where people are more reactive. One is around your emergency fund. Suddenly, people say that I have all my money in equity mutual funds. Now I have an emergency and I need to remove some of this money. Can I exit from this mutual fund? So that is also a reason that I find coming up, Kavita.
So, Shilpa, we're also talking about mutual fund universe, okay, where we have mutual funds specific to different categories, different sectors and themes. Now, an exit call would depend, apart from all these 3 factors that you just highlighted, sector specific or theme based mutual funds. How can one plan an exit strategy based on the kind of category a mutual fund actually belongs to?
Right. So when we talk about the category, let me start by talking about equity in particular, because most people look at a long-term strategy with a lot of equity concentration in their mutual fund portfolio. So when it comes to equity, it's very important that, especially when you're thinking about long-term goals, you want to exit as soon as you have just 2 to 3 years left to reach, you're approaching your goal and there's just 2 to 3 years to get there. That's number one. Or the other way to look at it is to say that I have created adequate amount for this goal and I have reached my target, I have completed the goal amount, so I exit. Now, when you're doing this exit, what can happen in equity is that there is a bear run going on, and at that phase, you sort of get jittery, should I remove my money or not? But here, the important assumption is, especially when it's comes to equity and long-term investing, is that you have already been invested in this fund for at least 7 to 10 years. So what we are hoping for you is that if the quality of the fund is good, you may have already seen a lot of upside. And if you've already reached your goal, it's okay for you at this point to start exiting from this fund. Now, what if you are in a bear run is an important question. So I think if the goal is negotiable, then you may want to wait out the bear run and then again start to, withdraw this and through a systematic withdrawal or through a systematic transfer plan into a safer instrument like a debt fund or a savings account. So that could be a strategy that you have around equity, Kavita. Around debt, I find that having a strategy around timing is not really important because these are mostly instruments which are way safer. If you are looking at something where it is a target maturity fund or a medium duration or a long duration fund, then definitely you would want to wait out for the entire period of the term of that particular fund because of the kind of bonds that they have invested in. Because if you wait out for the entire duration of the fund, then the interest rate risk really comes down for you. So I would suggest that if it is bonds, then wait out for the entire term and then exit from that debt fund. In terms of equity, if you can wait out a bear phase and then start redeeming from that fund, well and good for you. If you hit your target, I think it's a good time for you not to overthink it and start taking the rupee cost averaging and do a systematic withdrawal and start phasing out your withdrawals, but go ahead and start withdrawing the amount from your equity fund, Kavita.
Shilpa, also when you are looking at an exit strategy, what kind of tax implications one should be keeping in mind?
Great question. So when it comes to exit strategy and tax implications, whether you're redeeming this money into your savings account or whether you're doing a systematic transfer plan or a systematic withdrawal plan, it will be charged to you as a redemption. So that's very important for you to remember. Now, when it comes to equity, it's important for you to remember that anything less than a year. So if your holding period in this mutual fund is 1 year, then or anything less than that, rather less than 1 year, then you will be charged the short-term capital gain rate of 15%. Anything beyond a year, then the first 1 lakh of your capital gain will be totally free of tax. And everything beyond that will be charged at 10% long-term capital gains tax, Kavita. When it comes to your debt funds, we're talking about debt funds where, so when we talk about debt funds, we're looking at any fund where the equity exposure is anything less than 35%. So it could be 100% debt or it could be less than 35% equity. So in such funds, whether you hold it for a short term or long term, you're going to be charged as per the slab rate that you come under for your income tax, Kavita. And I think it's important for me to also mention that there is a category that is somewhere in between right now, which is your category where your equity is less than 65%, but more than 35% in a fund. So there you are still looking at getting the indexation benefit for anything if your holding period is more than 3 years, along with a 20% flat rate. So 3 years and beyond, indexation benefit and 20% flat tax rate. And anything less than 3 years, and you get taxed as per the slab rate, Kavita.
So all right. So in order to arrive to a decision where you think you should be exiting a fund, it's very important, Shilpa, to keep reviewing your mutual fund portfolio or for the entire financial portfolio if you have it invested in mutual funds. How often should one do it? Now, that's a very tricky question because, people get to hear do it every quarter, once in 6 months, or some people say do it just once in a year. Unless and until you review your portfolio, you will not know what fund to exit or maybe rebalance your portfolio. How important is tracking your portfolio and how often should you do it?
So tracking your portfolio is extremely important. And I think as often as you can do it, there are some people who like to do it once a month, as often as that, and they feel comfortable with that, Kavita. But I would say at a minimum, at least once in 6 months, do look at your portfolio to see what's happening with the different funds. Because if you are looking for underperformers, you want to at least track them for, say, like a 24-month period before you make up your mind on whether to keep it or to drop it. So it's very, very important that every half year at least you are looking at your funds and reviewing them carefully based on all the different parameters, Kavita.
All right, that will be all. Thank you so much, Shilpa, for being on the show and helping our viewers as to how they can take a call of exiting a mutual fund from their portfolio. Thank you so much.
Thank you, Kavita.
On that note, let's take a quick break and post that. We'll be talking to our viewers, getting them live on the show and sorting out their financial portfolio. And I'll be joined by Amol Joshi after this break.